Hello, investors and traders, and welcome to the weekly market report with Market Guys. I'm AJ Monty. Before I get into the meat of this report, I'd like to bring your attention to the Market Guys Facebook page, where yesterday I had put out an alert warning our subscribers that we could possibly see a secondary sell-off. And you can see right here, underlined it, put it in bold print. Can't make it any more colorful than this. To keep your eyes on the charts and to follow along with these reports. Why is it so important that we keep our eye on the charts? And well, here's the evidence right here. Last week, I said that we would most likely rally up. This is the Russell 2000 index, ticker symbol RUT. And I drew this line. Let me zoom in just a little bit more for you. I drew this line. Here is Friday. Monday we fell, formed a hammer pattern, and from there on out, it was as if the Russell 2000 was following my line precisely. And of course, that's not the case. But the end of the line right here was my target. And the reason I put out the alert on the Facebook page is because I started to see the formation of other markets with regard to the technicals. Let's take a look at the Qs so you can see this, and then I'll hop back to the Russell. You can see that the volume has been dropping quite significantly. See this? The drop in volume is a leading indicator that tells us the buyers are slowing down. So I was looking at the volume across the board. Every index was dropping. Stocks were dropping with regard to volume. The candles were turning negative, and we were losing momentum as we were hitting resistance. Now, going back to the Russell 2000, let me just say that this pattern today is a bearish harami. That's as bearish as a bearish engulfing pattern. And you can see down here, there is a gap below the market. That is what I'm putting as a price target. And I think we could pull back right to that gap fill point, and then we could possibly bounce. So in other words, I think we're going to erase all of our gains for this week, next week, and we're going to have to regroup. There's a lot of other signals that I'm looking at, first of which is the CCI down here. As I magnify that for you, the CCI is starting to hinge back down. Outside of volume, the CCI is what I consider to be a leading indicator because the formula really shows the speed at which the markets are moving and how that speed or momentum is changing. So the Russell 2000 is looking bearish. Going back to the Qs, I'm going to show you my forecast line there. I said we would most likely go down and bounce. We bounced and touched that target. This is the trend line that I highlighted. We went right to the penny right there on Monday, and then we bounced. So you could say that the market was a little bit more extreme with the bounce than I forecasted, but the end of that line being my target, we hit that on Tuesday. And again, as you can see, the volume is dropping. So what does that mean for the Qs? Again, the Qs represent more or less the tech sector. We have a gap below the market right here. I think that the tech sector also showing a bearish harami pattern right there. So as I magnify that as well. The small body candle falling within the larger green body from the day before, that's bearish. So I think we're going to pull right back just like that. And you can see the CCI down here is also hinging to the downside. Let's take a look at the diamonds. That's ticker symbol DIA. Left my lines on this chart as well. Hit my target right here. I said the diamonds will go low. We hit my target on Monday. I did not expect a bounce right away, but I hit my target. There is a gap now. Let me erase this line right here. There is a gap below the market as well, right across the board. Like I said, there's gaps below the market. Bearish harami right here, small body red candle and a green body from the day before. Drop in volume. I think we're going to pull back. Look at that drop. That's a 30% drop in the volume from the day before. And the CCI is hinging lower as well. I said that the CCI would drop a little bit before going up, which it did. I'm going to erase that. And I'm going to go so far as to forecast what the CCI is going to look like next week. I think it's going to cross with a sell signal right there. If we look at SPY, which is the S&P 500, same thing, right across the board. You can see that we hit the 20 period moving average as resistance, and we have a doji right there on lower volume. Now, for some of you, these terms that I'm using might seem a little foreign, and that's okay. If you stick with the market reports that I put out each week, you'll learn a little bit at a time. If you attend our webinars, you'll more or less learn by osmosis. Surround yourself with people who know this information, have conversations with them, stay plugged in, and you'll be able to take advantage of these price moves. Now, if we look at this, you'll see there's a gap below the market right there. I'm going to put that as my target price. The CCI is hinging, same story. Volume is dropping, which tells us that the buyers are losing some of that momentum. And a lot of this is really related indirectly or inversely related to the VIX. Let's take a look at the VIX. Volatility index, also known as the fear index, is starting to move up. I said it would move up. It hit my target on Monday right there. And now the VIX looks like it's starting to move up again. Let me erase these lines so I could forecast that for you. Look at the CCI. It's crossing back up over the momentum lines, hinging higher. The CCI is followed by the stochastics right here, also moving up. And so with the 20-period moving average acting as a support level right now, I think this bounce is going to continue into next week. Now remember, the volatility index is inversely related to the S&P here. So if we're bullish on the VIX, we're going to be bearish on the S&P. Now going back to the emotions attached to this type of a market, here we are Friday as I record this. I do not expect the media to be, all rosy-eyed and happy about what's going on with coronavirus. I do believe they're going to continue to fan the flames of fear. In turn, that could shake up the markets just a little bit. But I'd like to encourage you, each and every one of you, not to fear. I know sometimes that's hard when you're looking around at what's happening in the world. But please do not fear this. If you embrace it, prepare for it, plan for it, and basically team up with other like-minded people, you could actually not only survive, but you can thrive in an environment like this. For a lot of people, the market is now turned into a source of income. As an option trader, I'm going to tell you, we're having a field day. Absolute field day. With the increase in volatility, that means a higher return on investment for the trades that we're doing. In fact, last week I put out an alert for our option traders. We're basically locking in a 16% profit in a 24-day period. So less than a month, we're locking in a 16% profit on one of our trades on Boeing because we took a long position on Boeing as it bounced. So again, embrace this and look for the opportunities. Don't react in a knee-jerk fashion. Don't be reactive, be proactive. Look for the opportunities and stay in touch. Last week when we had the open house, pointed out a good number of sectors that are going to start to rally, and the money is flowing into those sectors. So again, as an investor and even traders out there, including the option traders, you could prepare and really have a great time in this market. So stay connected, don't fear, and I will do my very best to put this information out each and every week. And with that, have a great weekend. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.